So welcome everyone. You should be able to see my iPad here. So it's going to be a very informal session, this one. It's not really a proper training session. I don't have any slides. I am really just going to do a little bit of training, but more of a demo of the different financial analysis tools that I use and a few models. So the things I'm going to cover off, so it's really, the topic is really financial analysis tools. So just let me know if you can see that iPad. I did have a bit of a glitch the other day where people couldn't see my screen and my iPad. So hopefully you can see that okay. Just type in yes, all good, or whatever you want. So I'm going to go through a couple of 4 different tools. One is a break even and revenue target tool. The second is it's sort of a financial model. Oops, do that. So financial model, but also scenario tool. The third is a sort of a project-based profit forecasting tool. And that's probably more of a 3-month tool. And then the last one's more a 12-month profit/cash flow forecast. Okay, so they're the 4 things that I want to cover today. And I've got basically they're all spreadsheets that I'll show you and open to really just having a discussion around these, whether these are things that you've used in the past. Now, I've used different versions of these for different clients that might be on this call. But it's a good way to think about your business, think about a model that can represent your business and that you can then use to make better decisions, look at different scenarios, help you make different scenario decisions, but also understand what's going to happen with your profit and cash flow and what maybe the levers are. And as you change these levers, what it means to the bottom line in your business. Okay. And if you've got any questions as we go, just pop it into your chat window and I'll keep an eye on that as we go. All right. So first one. Now, before I actually go through and share, this is the break-even tool that I use. I might just recap very, very briefly. This is not a financial training workshop. It's really to showcase the different models and how to think about them. But just very quickly, the starting point is generally your profit and loss statement. So this is an example business. Now, I've gotten rid of the different income categories that this person captures, just so the business is a bit more anonymous. But it's really just starting with the profit and loss statement, understanding how to read your profit and loss statement. You've got income here, you've got cost of sales, which is generally the cost of delivering that product or service. But I focus on what are the variable costs, and I'll explain that in a minute. They're basically the costs that vary as your production or your service income varies from month to month. And then obviously you've got all the expenses down here, which are more fixed costs. And then you've got your profit down here. And whenever I look at a P&L, I always look at it in relation to another period. So in this example, it's financial year to financial year. But there is also, I also look at these on a monthly basis. So whenever I look at my clients' financials, I always look at it in relation to previous months, because then you can see how this month compares, if there's any fluctuations, anything that stands out compared to the trend in previous months. Just looking at, oh, sorry, just noticed there's a couple of people in the waiting room. Welcome for those that have just joined. This is recorded, so if you missed the start of it, then you can go back and have a look at that. So whenever you look at a P&L for the month, there's no point just looking at the month itself. It makes a lot more sense if you can compare it to other months. All right, so that's as much as I'm going to talk about in terms of P&L. So this first tool that I want to share with you is a very simple tool I use to help my clients understand what their break-even point is. And the break-even point is really the revenue that you need to generate to cover your costs. Okay. You can see here, as I said, it relates back to this P&L for this client. This simple calculation asks how many months we're looking at. So in this case, it's 12 months, because obviously if your P&L is only for 6 months, then you need to recalculate these numbers based on it only being 6 months instead of 12 months. And I won't go through this in a lot of detail, but what it does is the formula down here for calculating your break-even point is described here. It's your fixed costs plus any additional outgoings, and I'll explain that in a minute, divided by your gross profit percentage or gross profit margin. And that's why it's important to understand your P&L, how it's broken down between, especially the costs, how the costs are broken down between variable costs and fixed costs. And this one's a good example because in this calculation, I actually adjust the P&L cost of sales to exclude any staffing costs that are in there. Okay. Now, some businesses have, and as this business does, it has wages up here. And you can argue, and a lot of people do represent production wages up here in cost of sales. I take these out because they're really a fixed cost. You know, if your income halved 1 month, you'd still be incurring those wages. So really, this is a tool where you look at your fixed costs. Now, this is the P&L version, and this is the adjusted version once I adjust for those fixed wages that are in cost of sales. You divide it by your gross profit margin. That's why it's important to understand the breakdown of the P&L and what should be variable, what should be fixed costs. And it calculates based on that what your revenue target should be. Now, down here, just keep in mind as well that the profit and loss statement doesn't capture everything. There are additional loan repayments that you might have. There may be tax repayments. These things generally aren't in your profit and loss statement. So for example, if I just look at this down here, currently the revenue target for the 12 months in this example is 1.2 million. What I normally do and what I recommend you do is then work that out based on only having 11 months billable or income generating in the year, because you're always going to lose time over Christmas, December, January. We all know we've just had April, which is a shocker for productive days because of Easter and Anzac Day and so on. So you're always going to lose some time over the year. Some clients I even assume 10.5 billable months because there may be some other rain delays that we need to factor in and so on. So in this example, you've got 1.2 mil that this business needs to do to cover its costs for the year. And based on 11 billable months, that's 115 roughly thousand per month. Now, if there were loan repayments in here, and let's say those loan repayments added up to $100,000 for the year, once again, all depends on whether we're looking at 12 months, 6 months, and so on. You can see that this will then increase the revenue target from 115,000 a month to now 130,000 a month. Okay. So if there are loan repayments for equipment, if there's tax repayments, those types of things, then that will need to be factored in. Plus, once again, just remember, this is based on you just covering your costs and making zero profit. We obviously want to make a profit. So this calculation then allows you to enter in a profit target. So let's say for this sort of income, let's say this person's already paid themselves a salary and they want to make $150,000 profit. In addition to those $100,000 of loan repayments, they now need to be achieving a revenue target for 11 months of the year of 155,000 to achieve this profit target. Okay. So I've had a big brain dump there. So just a quick question for all of you. How many of you have actually done this exercise for yourselves? Obviously not using this worksheet that I use, but some other methodology. who knows their revenue, their break-even point, but also more importantly, their revenue target to achieve certain profit targets. So if you can just pop it into your chat window and just say yes or need to do that. So Gillian's sharing here. Or if you've got any questions, just feel free, unmute yourself and ask away. So Alex is saying yes for himself. Well, Alex is an accountant. You'd expect that. Antonella's I've been working with quite a while, and she's very experienced in business and knows her magic number. Sam, yes. Carol, no. Robin, yes. Roland says based on different sales scenarios they projected. Yep, that's great. What else maybe? Tamara. Coffee pods is too new, so I haven't done this. So it's definitely a good exercise, Tamara, even if your business, and I'll show you in a minute. Like my next tool is more around scenario planning for a new business or an early stage business, but any sort of business. Now you're right, Tamara. This sort of assumes you've got some P&L and historical financials, but you can do some estimates as well, even if you don't have historical P&Ls. Amber saying not yet, but we're going to start working on this, Amber, together. Yeah, Gwenda said, yeah, the management team said has given her a target, but never really calculated it for herself. Very good. Gillian's even shared her break-even points. Very good. Excellent. Okay, so that's the first tool. Does anyone have any questions before I go on to the next one? And does it sort of all make sense? You know, and you can sort of understand when I'm sharing some real figures why it's so important to understand this. But if anyone's got any questions, happy for you just to unmute yourself and ask away. Okay. So the next, oops, where are we? The next tool I want to share is a financial model that I use with some clients. Now, this one's set up for a trades-based business, but I think most people sort of understand. We've all used tradies, so we can probably understand a trades business. Now, this is someone that once again, I've taken out the real names and so on. This is someone I kicked off with just a couple of months ago. Fairly early stage business, only has been running for 6 months. Trades businesses can be quite profitable. You can see here, so this model is designed to show how much billable revenue this team can do based on their hourly rates, the number of hours that they can bill each week. And once again, in this case, I'm assuming 10.5 billable months per year. Okay. Then you've got some cost of sales, which is the materials they use for their jobs, any contractors they may use. And then you've got the labor cost down here, and then a general, based on his recent financials, what his average monthly overheads are. Okay. So whether or not this exactly is relevant for you, like this exact sort of setup, you can see the thinking behind it. It's about understanding what are the variables, what are the pieces of the business that contribute and add up to the final revenue figure and the profit figure. Okay, so it's understanding how your business works, what are the variables, and then building a model that takes those variables, and then you can start doing different scenario analysis around. So for example, and I've got some different scenarios down here that I'll go through with you. And this is exactly what we did with his business. He wanted to really think about, well, what are the things I can do to improve my business? What are the different options I have to grow my business? What does that mean to the bottom line if we look at different options? So these are the types of things that ideally you'd be able to build for your own business and then run some scenarios so that you've got some a financial understanding of what the impact may be of different decisions. And so a lot of what I do with clients is really helping them guide those decisions based on the numbers. And obviously it's not all about the numbers, but it's a big part of it. Okay, so Roland's just asked a question here. Don't you need to include superannuation? Yeah, so super's in here as well in this one. So it's basically, I've assumed just very, very roughly, you've obviously got 12% super plus another 2% in this case for workers, workers comp as a percentage of salary. So as you can see, this model is very high level, but hopefully it captures everything, all the main components of effectively of a P&L or a business's financials. So for example, and one thing that I went through with this client is he's undercharging. He's a new business. He's obviously hasn't had confidence in charging what he should be. Others are charging more like $110 to $140 an hour. So you can see here, currently it's saying roughly $100,000 in profit. If he increases to 110 for himself and his other tradesperson, that's jumping from a roughly $103,000 profit to $179,000 profit. Okay, so I always tell people that the profit is in the price, and this model just so easily shows, how that works and why it works. So in this example, so I'll just go back to where it was. This is his current situation. But I did a scenario where he increased his rates, both for his tradespeople and his apprentices. And so that, plus I've got a bit of a summary of the changes, plus increased his tradesperson's salary to $55 an hour. And that's the outcome. Now, if you hired a part-time admin plus rented a storage unit because he's just working out of his house at the moment, then obviously there's costs of the admin person, plus I increased, that's the admin person, plus I increased his overhead slightly. That reduces his take home or his profit. Instead of that, if you put another technician on instead, and so on. And then there was a scenario where he wants to grow to, which is having an office, having a full-time admin person, having another tech. What does that look like? Okay. So you can see it's interesting because he could stay where he is now and just increase his rates and be in the same profit position as having an office, a part-time admin person, another tech, and a more complex business. But this current situation is probably not sustainable because he doesn't want to continue working out of his house and so on. Okay, so it's just an example of looking at different scenarios. So, question for you, once again, has anyone done this type of thing for their business, looked at different scenarios, or built a model where you can tweak different inputs, whether it's your pricing, whether it's your productivity, whether it's whatever is important in your business? Has anyone done this as yet? Tamara said yes. Excellent. So there you go, Tamara. Even though you're early stage and you said you can't do that for your pod business, it's you've done that, which is great. Yeah. So Gillian, quick question, Gillian, do you want to just unmute yourself, if that's okay? You said you do this a lot with different options, but not on a spreadsheet like this.
Yeah.
Ask what sort of tool you might use.
The
Or
tool
is it really just back of the envelope saying, okay, if we increase sales, we know that we make this sort of margin and it'll add this much profit? Yeah.
Yeah, I mean, the margin, we will always know what the margin is because we've got different product categories.
Yep.
But my biggest tool is this guy. There he is. That's the biggest tool I've got.
They call me the tool all the time.
Is he your in-house finance guru?
Yeah, well, he's the my co-managing director and my partner, and he's been running businesses for how many years?
I was running businesses in Baghdad before you were in your dad's bag. Sorry, quite a long time.
Yeah, like 35 years.
Yeah, good stuff. And it's interesting, isn't it? Once you have that that sort of experience, you can really just make decisions on, well, I could say gut feel, but it's because the impact. Yeah, you can have a good feel and good understanding of what the impact may be of different things changing. But I still would recommend having it's great to be able to see it in black and white.
I like this. I like this. So it's got different scenarios of how you change the business and what your bottom line is.
Yeah.
Yeah.
So this is one
Okay.
version. I've got some other tools I'll share with you that might help as well. All right. And any questions? Thanks, Gillian. Any questions from anyone before we move on to the third tool, which is more of a forecasting tool? Roland's sharing a quote from someone I've never heard of, W.E. Deming. Without data, you are another person with an opinion. Yes. And you're right. One person who's got lots of experience, 35 years experience, people may just defer to that because they just trust that person. But if you can show that in black and white on a spreadsheet, and spreadsheets, it can be easy to make money on a spreadsheet. So if you, just be careful that, the spreadsheet is obviously only as good as your inputs and assumptions in particular. Even if all the formulas are correct, it really depends on your assumptions. Now, in this case, Paul, who's not his real name, we met less than 2 months ago. He's increased his rate to $100 currently, and then in a couple of months, probably July or so, he's going to increase to 110. So he's well on his way just with that simple tweak to really boost his profits. Okay. Tamara says, where does training go? What do you want to unmute yourself, Tamara? Not sure exactly what you mean by that.
I mean, the cost of training staff.
Oh, okay. That's all lumped into
under
this.
that on costs?
I've just lumped it into overheads here.
Okay.
Yep. So in here we have his P&L, and I just basically look at what the historical figures are for his expenses, and then take out the staff costs and just put a lump sum in here for everything else. Yeah. And obviously that needs to be reviewed regularly. As things change, we just need to make sure that those numbers are still relevant. And whether or not this is exactly, obviously we can't predict exactly what your profit will be, but it's ballpark, and it's more than showing what's the impact of doing different things to that profit. Okay. But once again, it's just about understanding, if you make certain decisions or you employ someone, what does that mean? How much extra revenue will it generate if it's a billable person? Or if it's not a billable person, how much extra time will that admin person allow you to do more billable work? So for example, in here, Paul's currently doing 30 hours billable a week, and he's doing a lot of admin after hours. If he gets another tech, I've said he'll have to do, like, the team will grow. So and without hiring an admin person, I've assumed that his billable hours will drop to 10 because he'll have to do more job management, which is not billable. But if he then hires someone, it'll go back up to 30, for example. Okay, so these are the sorts of things. It's about understanding what the impact of different decisions might be and making sure that you've captured those assumptions properly. All right, so the next one I want to share is a tool that's particularly good for if you're running lots of projects. So this is a trades-based business that has regular contracted income, plus they have project income. Okay, so this is a good tool. So I've got clients who they know their break-even point, they know their revenue targets, they have a ton of work on their books. So let's say you're back in that other example, the revenue target's $150,000 a month, and you've got $500,000 worth of contracts that you've brought on, and you know that you've got all this in the pipeline. That all of that work doesn't mean much unless you can hit those revenue targets. So it's about how quickly you can get that work done. So this tool then allows a project-based business to look at all the projects and then estimate when those projects will be completed or when milestones will be hit if it's a if that project goes across multiple months, and then how much you can invoice for each of those for that project across different months, and making sure that that then totals to your revenue target. Okay. And if it doesn't, then it gives you a heads up, a month or couple of months in advance. And you can say, okay, well, what can we do to either hit a milestone and invoice earlier than we would have otherwise? What can we do to bring in some extra work in there to fill in that gap? So it really just allows you to plan the coming month or coming couple of months ahead of time. Okay. So it is a good tool to do a little bit of short-term forecasting, for a project-based business. So you can see it's got income up here. You've got some cost of sales assumptions based on history, and then you've got your overheads down here, and then it calculates what the estimated net profit would be for those months, and then also any loan repayments that aren't in your expenses and so on. Okay, so Roland's asked a question. Actually, I'll go back and have a look at a few questions. So Julian's just saying, in the mining industry, price increases, you've also got to take the highs and lows of the mining industry. So so the propensity to accept price increases given, for instances, the world price for coal. Yeah. So I think what Julian's saying is that customers have a different appetite to pay higher prices to you based on what's happening in their world. And obviously the mining industry, if coal prices are high, they're feeling rich, they're happy to pay, extra to suppliers. Plus there's probably also more production happening and there's more need for to use suppliers, or there's a number of suppliers, so therefore they can charge more for their services when things drop back, whether it's the mining industry or whether it's consumers. Obviously, if consumers are all out there making lots of money and they all want coffee pods or new kitchens or whatever it might be, you can obviously charge more. When times are lean, then you may need to trim or offer some other incentives for purchase. So every business is going to be impacted by that. Now, one thing I haven't talked about in terms of pricing is, especially for the consumer market, is really looking at how you can position yourself better. Now, I've got a lawyer client on the call here. Some lawyers will charge less than other lawyers, because it's all about how do you position yourself, have the confidence to price higher, market your business so it looks attractive. There's a perception that there's more value in it than it's not just about the price. So that's all of these things come into it, but that's for a different training session. All right, so what else do we have here? If you have deferred payment behavior from customers, do you baseline the month? Yeah, okay. So good question from Roland here. So this forecast is really based on invoicing and what your profit will be. You may not receive all of this money that you've invoiced in the month. You might have, especially if you've got business customers, they may take you 30 days or even 45 or 60 days to pay. That's a different consideration. The first thing I focus on is making sure you're hitting your revenue targets, invoicing enough each month to not just cover your costs, but then to make the profit that you're targeting. How you manage cash flow is a different consideration. Okay. And that's something which you'd need to think about separately. And every business has got different cash flow issues. It could be collecting cash from business customers, and especially large business customers or government. Or it could be buying inventory and managing that. So cash flow is sort of outside of this. It's more about just making sure we're hitting the profit first. You can't have good cash flow unless you've got good profit. Okay, so that's the starting point of good cash flow. All right, I better keep moving on. Last one I want to share is another forecasting tool, which is more of a 12-month projection. So this is one that looks at a business and looks at how a business is progressing over the next 12 months. And I also do this for annually for clients as well. So there could be, this could be year 1, year 2, year 3, year 4, year 5, especially if it's a business that's looking long term. What are they looking at changing in their business over that time? How much is their team going to grow? Are they looking at opening up multiple offices? What are all these big picture changes over multiple years that might be happening, or in this case, over 12 months? So in this example, it's a client that had an existing service, is starting a new service. So it could be like Tamara, who had a coffee, like a cafe, and wants to start a coffee pod wholesaling business, for example. In this case, it was the same sort of business. So that's why these cost of sales are similar. And then as that business grows, what are the different changes happening? So here, wages would be growing from in line with this new income starting, because there'd be new staff that need to come on board. There was some rent in an old premises which would be falling away. So you can see that it's about understanding what's going to happen over the next 12 months and then looking at forecasting that. You can see there this business was unprofitable, and based on this new service that they were putting in place, this would be the new profit forecast. But then down here, they also had a lot of loans, unfortunately, and you can see even though this profit looks really healthy, it was it needed to be to cover the loans. Okay. And when I say cash movement, once again, Roland, it's not strictly cash in this case. It's really profit less other repayments. And then in this case, there was all these assumptions that explained why things are changing, what assumptions we made for the starting point, and so on. All right. So any questions about that one? So that's another one that you can take on board and see if it might be relevant for your business, especially if you're either starting out or if you're looking at making changes, and then over the next 12 months is going to be some quite dramatic changes. Now, I know Antonella, who's on this call, does this every month as part of a budgeting exercise. And it's good, even if your business is fairly stable, to understand what the impact of December, January in particular might be, how much that may impact your revenue and your billings, and also things like April, which is always another low month. Okay. So any questions about that one? Who's been bamboozled by all of this, or thinking, wow, I need to I need to get my financial get some of my financial metrics or understanding and that type of thing in place? So, and good bookkeepers can help you with this. Some accountants, but a lot of accountants are generally focused on compliance and tax, which is obviously an important area, but they're busy enough with that generally. And otherwise, it's really left to you to really understand how to run a spreadsheet and run these numbers. It's which is not a skill that a lot of people have. So questions. So actually, first of all, key takeouts. So that's all I wanted to cover. It was those 4 tools. Once again, if I just go back to this, it was that break-even revenue target spreadsheet and tool, the financial model and scenarios, the project-based profit forecasting, and also just a more broad 12-month profit or cash flow forecasting tool. So if you can open up your chat window, just tell me either the main takeouts or the key actions that you think you need to focus on out of this quick training/demo that I've just done. Yeah, so Roland says he calculates his break even in a different way. And there are different ways. This is the way I use. It's basically gross profit margin or percentage divided by, sorry, your fixed costs divided by your gross profit percentage, and make sure those fixed costs include loan repayments, other things that aren't in your P&L, plus also a revenue target if you want to do that. Okay, so what else do we have here? Said review regularly and keep the spreadsheet relatively simple. Yes, I believe in the KISS principle, Tamara. Keep it simple and succeed. I don't like to say stupid, but yes, keep it simple. So Gwenda wants to go and look at a break even and revenue targets. Great. And Gwenda, I know in your situation, it really just depends on what's happening in the market. It's great to have a revenue target, but at the end of the day, it's you've got to have the business there to the customers there to generate that. Gillian just saying, I don't know if it's Gillian or Gillian, but anyway, it's revisit the way you do break even and revenue targets. Good. So Maria is on the call. She's my go-to finance person. So anyone who needs any help with loans, whether it's resi, commercial, even just your banking transaction and overdraft accounts, Maria's your lady. So yes, definitely, the importance, how important it is for businesses to understand their numbers and stay on top of it. Yes, Antonella. So Antonella is part of, well, she's a client, and yes, you're right. These are all available to my Profit Collective group. So this meeting that we're having today is a client meeting that I run every Wednesday. And partly it's training, partly it's just business discussion. It's about making sure people are on track with their plan and doing things in the business that they need to do, but also having a group that you can ask questions to. So that's the Profit Collective group that I run. And I've just invited a few guests in here just to take part in this training. So what I will be doing is just after we finish this quick training, I'll probably just ask non-clients to leave, and I'll continue with my clients and other discussions and other issues that they want to discuss. But we'll just go through some of these takeouts first. Oh, Robin, I didn't know you were on the call. So welcome. Robin's another accountant, so it's good to get some feedback from people who understand the numbers.
Thanks,
right, so
Anil. Thanks for the invitation. Since I'm not a client, I will leave you now. But thank you very much.
Thanks, Robin. Talk soon.
Okay. See ya.
Cheers. Now, Carol's just asked a good question. Do you recommend a minimum percentage profit margin? Now, it really depends on each business. Some businesses have a really high volume and low margin, and can create a lot of revenue for the staffing base that they have. For example, a manufacturer, so their profit margin may be a little bit lower. I would generally aim for 10%. So I've got clients that make 20%. So this is a percentage of their income as profit. So for example, if your revenue is $1 million a year and you aim for a 10% profit margin, that means $100,000 of profit. And ideally that would be after you've paid yourself some sort of reasonable salary. But once again, it depends on the business. You could have a business that does $500,000 of revenue and makes $200,000 profit. It really just depends on the business. So what I normally do is more look at these sorts of scenarios, what we can tweak, what the impact might be, looking at your financials now compared to the last couple of years, and then looking at just understanding more about the business and what we can do to change things, change pricing, for example. There's no point limiting yourself to say a 10% profit margin if you can achieve a 20% profit margin. Okay. So thanks everyone. I think that's all the questions.